Part number one. We got ahead of ourselves. Let's understand what we're doing first. The $1 investor. Like and subscribe. Let's go. The big picture. Imagine a giant marketplace, not for apples and oranges, but for tiny pieces of companies. When you buy one of these pieces, you become a part owner of that company. This marketplace is the stock market. Companies use it to raise money by selling shares. Investors use it to trade those shares, hoping the value goes up. The stock market is the place where supply, shares being sold, meets demand, buyers wanting them, and the price is determined by what folks expect the company will do in the future. Growth, profits, good management, things like that. How it works. First, a company decides it needs cash, maybe to expand, launch a product, or pay off debt. It issues shares in an initial public offering IPO so investors can buy in. After that, those shares trade on a stock exchange. Traders and investors decide, is this company going to make money? If yes, buyers push the price up. If doubts appear, sellers push it down. Behind that simple buy and sell game are billions of pieces of information: quarterly earnings reports, new product launches, competition, regulation, the economy, all that affects the company's perceived worth and thus its share price. When you hold a share, you share in the company's gains and losses in proportion to how many you own. Why it matters. For the company, the stock market gives access to capital at scale. For the investor, it offers a way to grow wealth, beat inflation, and participate in the economy's success. But there are risks. Markets go up and down, often for reasons that aren't obvious or fair. Sentiment, how people feel, can drive prices more than fundamentals, how the company actually is. The stock market reflects both the real economy and the psychology of its participants. Key concepts. Here are some must-know terms. Share/stock, one piece of ownership in a company. Dividend, a payment some companies make to shareholders from profits. Capital gain, what you make if you sell a share for more than you paid. Index, a basket of stocks, like the S&P 500, that tracks the market's overall performance. Bull market versus bear market. A bull market is when prices steadily go up. A bear market is when they trend down. Volatility, how wildly prices move. More volatility equals higher risk and higher reward potential.